Good morning, it's Randy Kirk, and some of you are probably wondering what in the heck is going on in the stock market. And I'm not an investment advisor. I don't have any certificates. I've been playing it like you maybe for years, but I do have a few ideas for you, and do your own research. Do not take anything that I say as being gospel, just my experience and a little bit of knowledge over the years. So let's dive in. What in the world is going on? And I think I've got about 13, believe it or not, reasons why the market is doing what it's doing, and why specifically Tesla may be doing what it's doing. I could be wrong on 12 of them. I could be right on all of them. Who knows? So let's just go down them, okay? Let's start with Tesla is a story stock. It's always been about the narrative. It's always been a go-go stock that had a lot of people talking about the amazing future that there is in the future. The narrative hasn't changed. If anything, the narrative is more exciting than it has ever been. However, when you have a narrative stock, a story stock, then you're going to have people on the other side, people that don't buy the story. They don't get the story, or they are literally against the story because it's going to impact them personally. Well, when you're in a positive market and everybody's a genius and things are just going up, 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 then the story stocks tend to get a lot of traction from various different groups of people. We'll talk about a couple of those groups as we go down the list. But when the stock market's going bad, well, all of a sudden people are more inclined to think negatively. And so story stocks, narrative stocks don't do as well. So that would be one major reason. Not enough new blood coming in that are buying into the narrative and looking for the opportunity to make a lot of money. There's no more fear of missing out. Right now, the fear is all on the other side. All right, so let's move on to number two. Number two is the retail investor has gone rabbit. Not rabid, rabbit. So when the stock was going up and when the market is going up and when everybody's a genius, well, there's a lot of retail investors that want to get in on the ride. They want to be part of the excitement, and they also have their friends telling them how much they've made, and they're watching all kinds of TV shows and YouTube videos and Twitter, wherever they are. They're seeing all these people talking about how much money is being made, and they want to jump in and take advantage of the opportunity. Well, that same retail investor right now is hearing from their friends and from the television and from YouTube that the market is collapsing and that Tesla's stock is collapsing. And so there are no new retail investors jumping in. And in fact, there's a whole bunch of those retail investors who've now bailed out. You may remember 2007, 2008, where the market crashed so badly. 2009, it crashed so badly that we lost a generation of investors. We lost a whole generation of people who said, I'm never going to invest again because I lost so much money. Well, we have so far at least a minor example of that taking place right now. So those folks are out and they're not likely to get back in. Number three, Elon's stock sale. Of course, Elon, he took liquidity out of the market. That's a whole bunch of money that is no longer in the Tesla stock. So of course it has an impact, and it has a bigger impact in a down market. Once again, in an up market, other investors would come in, liquidity would be provided in order to suck up the shares that Elon sold off. But in a down market where the stock is already illiquid, then you take out that kind of cash, and it's obviously going to have an impact on the stock price. So there's a few percentage points that definitely would have that as part of the problem. And there might be other large investors who have sold off. Some of those have been pointed out, but there's also large investors getting in. Kathy Wood at ARK Invest, we've seen purchases over the last few weeks. So there's some of both of that, but I would say that the Elon Musk would be a fairly substantial hit, but that would be temporary because then the liquidity levels out again. So that would only be a temporary situation. Number four, we kind of talked about kind of the same thing. There's not new money coming into the market to replace the money that's going out. So there's a lack of liquidity. And we'll talk more about that in a minute. Number 5, there's a macro thing, a general sidelining of capital, by everybody who is investing their money, looking for safer havens. You have the traditional switch of categories where people are getting maybe into a Costco, are getting into food stocks, other kinds of things that are safer in a recession. So you would have that normal shift. You have people shifting out of go-go stocks and things like that and getting into the safer investments in stocks, bonds, even in treasuries, which we'll talk more about as well. That would be the next one. So Elon even said in a Twitter conversation just yesterday, he said, look, if you can get 4%, 5%, even 6 or 7%, that is almost guaranteed and has almost no risk associated with it. Well, that's going to cause a lot of people to shift money into those higher yield investments that are still extremely safe. Even a year ago, your money, you were lucky if you were finding 3%, 2% investments that were safe. But now you have investments that are 4% and higher that are very, very safe. That causes a massive shift of thinking in terms of where people want to go. You also have an aging population. So I'm a baby boomer, and folks in the baby boom generation are looking for safer investments. I personally have this much set aside into safer investments, and then I have this much over here to play with. But I will tell you that this morning, we shifted some of the safe money over into Tesla stock. So, come on, I'm not that old. So that's there may be some of that taking place in the next weeks as people who have had their money in safe investments or have shifted money into safe investments even over the last few months. Now we'll say, okay, these opportunities are doing great. So we'll talk about some of that in a minute too. All right. Risk off mentality. In this kind of a market, I don't care what kind of business it is, you're not going to get as much money for your business. I happen to have been forced to sell a business in 2007. I didn't have a choice. And the August of 2007, I got about 25% of what the value of that company would have been even a year before. So this is always true. I've helped companies buy and sell businesses through my consulting practice, and you're always going to get a lot more money for a small business, big business. It doesn't matter. You're going to get a lot more in a good market than you are in a market like this, where risk is off. Okay, so it's a huge macro impact. You will have some people that are responding right now, especially in a market like this, who would be responding to Elon's Twitter acquisition, some of his political statements and whatnot. Whether you agree with Elon or you don't agree with Elon, some of the statements that have been made would cause some people to think that he was politically to one side or the other. Politically, right now, people would say more right wing. I would call him a centrist who has a streak of independence that has nothing to do with either party. But some people would say, oh, he's moved right. And that might cause them to, example, last year, there was a big sell-off in Disney stock because of all the things that were happening down in Florida with DeSantis and whatnot. There was a big sell-off in Disney stock way before the market started going down over those kinds of political issues. Those are not going to last. When the market starts up again, people start becoming less ideological and much more interested in where can they make a buck. So yes, those issues will have an impact on some people saying, I don't want to be in that stock because I'm ideologically different than that person, and I'm not interested in supporting the company. And those people might also not want to have it in their portfolio where there's visibility, where other people are going to say, oh, you have some You have some of that stock in your portfolio. What's wrong with you? So virtue signaling. So I would say definitely that's impacting the stock as well. Okay, some fear of brand damage. So certainly been the conversation on Twitter for the last week or so, people arguing one way or another whether there's brand damage. I'm going to say I'm a brand guy. Okay, I'm a marketing guy. If you've been watching me, you know that's what I've done my whole life. I'm a sales and marketing guy. Sure, I ran plastic manufacturing business, and I've run a whole bunch of different businesses, so I'm entrepreneurial. But my gut, my heart is in marketing and in selling. And I will say, sure, you can definitely have brand damage from some of these same kinds of ideological issues. People were not shopping at, they weren't going to shop at Hobby Lobby for a while, and they weren't going to shop at Starbucks for a while. And again, there were bunches of my friends who were saying they weren't going to go to Disneyland. That stuff all passes. It's temporary. People, it's the money stupid. People make decisions based on practical things when it comes down to it. Sure, there's going to be a small fraction of the community who might never buy another Tesla because Elon said, but there's another fraction of the market that's going to say, I'm going to buy a Tesla because Elon said. So, but over the long term, that's not going to be how people are going to make their purchasing decisions. Some brand damage right now, yes. But I'd say it goes away based on my experience. Okay, so the correction, it looks bigger than it is. Let's skip that one. Let's come back. Go-go stocks tend to overcorrect in both directions. Okay. So when you get a stock that goes, oh, I know. So this is kind of part of this last one, which I was getting confused. I couldn't remember my notes. So when Tesla was worth 1.2 trillion, that was an overreach. The market was correcting too high. Now, if the entire business climate had continued to go crazy and the stock market had continued upward, those numbers might have been able to maintain and even go higher. But most markets don't last forever in one direction or the other. So there was an overreach in that direction when we hit 1.2 trillion in value. The same thing happens in the other direction for those kind of stocks. I've seen it my entire career of watching companies. So when the market is off, then there's an overcorrection in the other direction. And I believe that's what's happening right now. I think we're seeing a very big overcorrection in the market and a huge overcorrection in go-go stocks like Tesla. So if you look at any of Kathy Wood stocks, if you look at ARK Invest, but if you look at the underlying stocks, you'll see a lot of those are also overcorrecting. Some of those are off 80% and more. So that's another tendency, a macro that you have to watch out for. And that's what is also taking place right now. That will correct the other way when things start the other direction. There will be Tesla tends to maybe be 2 times what the market is trending. So if the stock market goes up, the equivalent of let's say 1%, Tesla goes up 2%. If it goes down 1%, Tesla goes down 2%. So you're seeing that kind of over correction at this point as well. Okay. I would say, I mentioned this morning on Twitter, this looks like capitulation. So it looks like the end of the bear. It looks like where we would see a big sell-off, massive sell-off after a week or 2 or 3 of selling off, and all of a sudden there's a big day of selling off just before a holiday. Kind of looks like capitulation. But again, don't use my advice. Do your own homework and read up on capitulations, read up on what might be the next leg down. So sometimes it's hard to tell whether you're in a capitulation. You might get a dead cat bounce and then another leg down. You might get a dead cat, or you might get a bounce and then back test the lows. Really likely, according to people that I trust right now, that we will see a reaction off of these lows. I think that would be obvious. The reaction might last into sometime in January, and then we might see another leg down. We might see, or we might not a leg down, we might see a test of the lows. So really hard to know. Those are always the things that are hard to guess, but those are some things to watch out for. Okay, what do we know about Tesla that would cause us to think this is a really, 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 really good time to buy? First of all, the fundamentals, the foundational stuff hasn't changed at all. Gary Black and others are, other pundits are saying that they're looking at $7 in earnings next year. So right now we're looking at 20 times forward earnings, which is 20 PE on forward earnings. That's crazy. I think $7 is ridiculously low because the pundits who are saying it's going to get to 7 are not taking into consideration anything for energy. I think it's very easy to see that there's going to be at least $3 a share in energy storage next year. Watch my other videos on this. We've been talking about it all this week. Nobody's talking about Lathrop. Lathrop is going to do 20 billion next year at 20 to 30% margins. It's going to have a very big impact on the bottom line, and that is not being figured into any of these pundits' schedules for next year. The other part is the IRA. Nobody's figuring anything in for the IRA. I think the IRA is going to be worth $3 a share. I mean, $3 a share in earnings. So we go from 7 to 13, possibly 14. Well, that's a doubling of the earnings compared to what the street is looking at. And some of the street don't even believe the $7. So that, of course, assumes that everything stays the same in terms of projections of sales of automobiles. Well, okay, let's go through that list. The United States. It is possible that we could see that every car that Tesla can make in the United States doesn't sell next year. I'm having a hard time seeing how that happens with $7,500 off on most of them. And with Tesla having pricing power. And I'll throw in I haven't said this anywhere yet. You're the first to hear it. Maybe I'm right, maybe I'm wrong. But I think that Tesla will use that pricing power next year to make sure that they sell every car they make. Now, why would they do that? Why would they lower their margins, potentially at least lower their margins in order to keep the numbers high? Well, there's a bunch of reasons you would do that. You would do that in order to keep your production at a level which keeps your cost per vehicle lower. If you slow down sales, if you slow down production, then you have higher cost of goods and you have higher overhead as a percentage of your total sales. So maximizing your sales in a situation like this by lowering your margins just a little bit would totally be a smart thing to do. Plus, we know that every Tesla that gets sold is just one more advertising piece for Tesla, because people talk about their Tesla, people get their first ride into Tesla. So it is impossible for me to imagine a scenario where Tesla is unable to sell every single car that they make in the United States next year. Every single US made car will sell in the United States, including all the new ones that are going to be built in Austin. So those numbers, I think are pretty clear. I don't think they'll have to lower margins at all. And also there's a lot of lowering of commodity prices in this recessionary environment. So their costs are coming down, potentially in raw materials. Their costs are going to be coming down because the ramp is higher, and their costs are going to be coming down because their overhead as a percentage will come down. So all those things are going to impact the fact that, which would allow them to reduce prices without losing any margin at all and keeping the margin at around 30%. All right, let's move on to Europe. They're only going to make 300 to 350,000 cars in Berlin this next year. I think that it shouldn't be that hard. I could be wrong, but I think that the European market can absorb 350,000 cars next year. Maybe not, but how many fewer? 50,000 fewer? Once again, they can lower the costs if necessary. Europe might put some new incentives on. Who knows? I don't know any of those things. All I can say is I think that that Tesla will also do whatever's necessary to sell every single car that they build in Europe. That takes us to Shanghai. Shanghai is an export hub. Everybody keeps forgetting. I've said it in other videos. I'm going to say it here again. Shanghai is an export hub. Australia, New Zealand has never gotten enough cars. They've had backlog. They finally got a lot of cars over the last 2 months, but they're going to want more cars. There's just no doubt about it. They've just opened up. Thailand. Thailand is starting to get cars. They're beginning to set up to ship to Turkey. That was just announced 2 days ago. We have all of the UK. All of the cars in the UK come out of Shanghai because they're right-hand drive, and all of these right-hand drives come out of Shanghai. All of the Model 3s for all of the world except the United States come out of Shanghai. So you have massive numbers of potential Model 3s being shipped all over the world, including Europe, because they don't make any Model 3s yet in Berlin. You have multiple new markets that could be opened, just like they just opened Thailand and just opened Turkey. So imagine that maybe they're going to open one new market a month. I don't know if that they will do that, but they certainly have lots of markets in Southeast Asia, in Asia Pacific, in Africa, in South America. There's lots and lots of markets that haven't been touched yet. So I think that the exports will take care of any shortage that might happen in Shanghai in terms of the China market. But let's say that I'm wrong. Let's say that, in fact, just like we talked about a minute ago, they have to lower prices in some of those markets. They have to lower prices in Shanghai. It's possible. Some of those things may have to happen in order to sell the 1.2 million cars that they will make in Shanghai. And I'm hoping it'll be more than 1.2 million, but that's the kind of the guess for most people. And that's on my numbers, is 1.2 for Shanghai. So we're back to where my statement is. We're still looking at 2.65 million cars being manufactured next year and shipped and sold, as opposed to the 2.1 that the market leaders are talking about. Well, that's another $5 a share if I'm right. So at some point next year, when these three catalysts come into play, which are the catalysts that I think are obvious and known: energy, IRA, and much higher car sales at good margins, then the stock will have to take off from current levels and should potentially go to the moon. Well, again, I'm not an analyst. Do your own homework, but I thought I should really bring this story to you. And I hope that this has been valuable. If it has, do all those things you know to do, like and subscribe and the rest. And it's been great talking to you today.